today we'll see an example of journalizing, adjusting entries, and preparing financial statements, which is one of the final steps in the accounting cycle. So here we have both unadjusted and adjusted trial balances for Monotic Advertising, which is a digital marketing agency located in Ottawa, Ontario. And we have this data as of December 31st, 2020. And the first task is to journalize the annual adjusting entries that were made. So we have a balance of 120,100 here for the unadjusted trial balance, but that balance changed because of these adjustments, obviously these changes, and the new balance is $130,050. So let's journalize these adjusting entries, and we'll look at the differences between the two trial balances to see where the changes were made. We see that cash didn't change, 14,000, but accounts receivable, it looks like it went up by $3,500. So let's account for that. And normally this is caused by increase in revenue or sales. So it looks like yes, service revenue increased, and it increased by $4,900, I think. But only 3,500 of this increase is causing the increase in accounts receivable. So accounts receivable, we have 3,500, and then service revenue also increased by 3,500. So let's account for the remainder of this of the increase in service revenue, and that, if we look here, it looks like unearned revenue, it went down. It looks like the company earned some of its unearned revenue or some of its liability here, so it went down from 7,000 to 5,600. So unearned revenue went up, went down, so the liability account is going down on the debit side, so $1,400, and service revenue went up by the same amount. So this gives us, these two changes give us $4,900 increase in service revenue. Alright, so let's look at here to see if we see any other changes. Supplies, it looks like went down from $8,400 to $3,000. So this is normally caused by supplies expense, and it looks like supplies expense were $5,400. So let's record that. Supplies expense 5,400, and our supplies inventory is also, it went down by the same amount. So supplies asset went down by $5,400. Next, we keep looking further down here, we see that prepaid expense, it went down from $3,350 to $2,500, and this is caused by, obviously, insurance expense, which was $850 for 2020. So let's record that. Insurance expense $850, and prepaid insurance decreased by $850. So our asset prepaid insurance went down by $850 here because of this expense, insurance expense. Next, we have equipment which didn't change, but accumulated depreciation went up by $5,000. right? And it makes sense. The company operated 1 year, and obviously they have depreciation expense. So that's $5,000. Let's record that. Depreciation expense 5,000, and accumulated depreciation was 5,000. Next, we have interest payable. So it looks like the company had some interest expense, which was $350, and that balance changed to $500. So that liability went up by, and that caused this interest payable liability to go up by $150. So interest expense $150 and interest payable $150. And it looks like there is one more change we should account for, and it is salaries and wages. It looks like it went up by $1,300, and this is of course caused by salaries and wage expense, which increased from $10,000 to $11,300. So salaries and wage expense $1,300, and salaries and wage payable. This liability account also increased by $1,300. Looks like we're done. We're done with journalizing the annual adjusting entries that were made in 2020, at the end of 2020. And now we'll prepare an income statement and a statement of retained earnings, as well as an unclassified balance sheet at December 31st. We'll start with the income statement here. The template is given, and we have the revenue section, and the revenue. The only revenue account we have here is service revenue, which was $66,500 at the end of the year. So let's record that, service revenue, and that was $66,500. And we have a number of expenses that we can copy from here. Also, let's copy the corresponding values. Alright, and let's just sum these up to come up with total expenses, which were some of these, $27,050, and then we have our net income, which is the difference between the service revenue and total expenses. So in terms of financial performance, it looks like the company made almost $40,000, $39,450. Next, we'll prepare a statement of retained earnings. So here we'll start with retained earnings at the beginning of the year. Retained earnings. Let's put here January 1st, and the balance on January 1st was, let's put it here, it was here 3,500, and since the statement of retained earnings shows total retained earnings since the inception of the company, so this is the balance that we started at the beginning of the year, which shows overall accumulated retained earnings for the company. We need to add the net income for the year to come up with the closing balance for retained earnings. So net income for the year was 39,450, and then we have the final number for the retained earnings account. Retained earnings on December 31st, at the end of the year. So make a quick change here. Retained earnings, and that is the sum of the two here. So the beginning balance plus net income for the year should give us this. I don't know why it's being coded as date. Let's change that. Okay, 42,500. Next, we'll prepare a balance sheet for Manatic, and here we'll start with assets, and we'll look at asset accounts of highest liquidity, and there we have cash. So we'll start with cash. The cash balance was 14,000. So we'll see that, and we'll look at the cash balance on the adjusted trial balance, and that's 14,000. And then we have a number of other assets or current assets, and that the next one is accounts receivable by its liquidity level. Accounts receivable, and that number is 23,500. Next we have I believe prepaid insurance, which stood at 2,500 at the end of the year. Prepaid insurance asset account, and that is 2,500. And oh, by the way, we also have supplies here. We missed supplies, so let's put supplies in between here. Usually supplies are of higher liquidity, so let's put supplies. I mean, it depends on supplies, but normally supplies come before prepaid insurance. And the supplies balance was 10,000. Alright, so let's put it here. Next we have it looks like we have equipment, which is a longer-term asset. So equipment. The balance there was 60,000. So we'll put it here because we'll adjust the equipment balance by its accumulated depreciation, and we'll put the net figure for equipment. So accumulated depreciation for equipment we saw was 33,000. So the net amount here is the difference between 60,000 and 33,000. And then we have our total assets. Total assets is the sum of these all. Just the sum. So the total assets, the company's total assets are $70,000. Next we have liabilities. For liabilities, we'll start with less liquid liabilities here. So it looks like we have notes payable first. So notes payable, which stood at I think stood at 5,000. And then we have accounts payable. Next, accounts payable, and that was 5,000 as well. Next we have, it looks like unearned revenue. So we're going to record that, unearned revenue, and this account had 5,600 in its balance, so we'll put it here, 5,600. And I think I also saw salaries and wages payable, so we'll put that one here, and the balance there was 11,300. Alright, salaries and payable balance, so let's make sure that we're getting the payables. 1,300, sorry about that. And it looks like, let's make sure, it looks like there's also interest payable. Let's put that one here as well. That's a liability account, and the amount there was 150, so we'll include that. Alright, looks like we don't have any more liabilities, so let's total all the liabilities. So total liabilities. Total liabilities is the sum of these all. Oops. Let's make sure. Sum. And $17,050 is the amount of total liabilities. Let's do shareholders' equity. And here we will look at things like common stock, if they have any common stock, and the company does have common shares, and we can see it here. The balance there is $10,000. So let's put it here. Common shares, 10,000, and also retained earnings going here. So the balance of retained earnings we computed was 42,950. We'll put here retained earnings. Alright, and the total shareholders' equity is the sum of the two here. And that is $52,950. Finally, we can do total liabilities and shareholders' equity. So for total liabilities and shareholders' equity, we have $17,050 plus $52,950. And that is $70,000, which is equal to the total assets we have here. So it looks like, our total assets are equal to our total liabilities and shareholders' equity. So it's our calculations are in line with the accounting equation, which states that total assets should be equal to total liabilities and shareholders' equity. Just to recap, we have seen an example of journalizing. We've journalized the annual adjusting entries for this company, and then we have prepared financial statements, starting with the income statement, the statement of retained earnings, and the balance sheet for Manatic Advertising. I hope this example illustrates the process of journalizing, adjusting entries, and preparing financial statements for you. Thanks.